So one of the things we look at is we don't just look at back-tested data. We look at live data. How has it performed since it was incepted? When it hit the market live, how has it done? And knowing that we have we can see the correlations of the different asset classes in the marketplace with equities and bonds and commodities and things, we can see how it actually should have performed based on the methodology. So if you have an index that is following the S&P 500, and we know that the S&P 500 did X last year, whatever that number is, we know that's what it did because we have the data. But then we see this newer index that says it follows the S&P 500, but has a fancy algorithm that tries to manage volatility and maybe incorporate some bonds or commodities to the equation. And we see that it didn't perform at all. That's a red flag. But those are the things that we look at. And those are the things that we help our clients understand, is how to look at that and then help them trust themselves and trust us that we're helping them make a good decision.
Yep.
One other thing, I know I'm getting long-winded here about indexed annuities, but they're pretty involved products. One of the things we look for is not just having an annuity, a fixed indexed annuity, having a good index, but having a multitude of different good and proven indexes to choose from, so that you can diversify your allocation within the product. Just because we're looking at fixed indexed annuities doesn't mean that we want to necessarily deviate from the most important rule in investing, and that's diversification. If we can find a fixed indexed annuity that offers us a blend of proven indexes, that just betters our strategy, because we're not putting all our eggs in one basket, or in this case, one index. We can sprinkle the allocation across a few and have a better chance to smooth out the returns and, potentially eliminate or at least improve the probability of not getting a zero in any given year.
Yeah. Which, going back to the sequence of returns.
Yeah, exactly right.
And I think it's worth noting that of all the annuity types that we've covered, fixed index annuity, if we're using it for the purpose of lifetime of income, would be the only one that has a fee associated to it, right?
Yeah, exactly.
There is a value that comes behind that, and it's commonly what I'm seeing, and what you're seeing is that most commonly we're seeing a higher income guarantee on this product in comparison to single premium immediate annuity. That's not every day, but it does commonly happen.
Yeah, absolutely. Yeah, so that's one of the things. I think that's a good segue to our next topic, and that's the downsides and things to consider when evaluating annuities, right? And one of the things that we hear all the time, and we see the advertisements for people that are anti-annuity, which, by the way, you just have to be careful. There's a lot of bias out there. There's a lot of investment advisors and whatnot that make a living giving you investment advice on your 401ks, IRAs, and brokerage accounts, and helping you manage stocks and bonds and other asset types. But you have to understand, they're making their living off of that. So when you buy an annuity, that money can no longer be charged a fee from the management side of things. So they lose money if you move your money to an annuity. And so there's a lot of firms out there that are anti-annuity. There's a big one out there that's completely against annuities, and they actually have spent millions and millions and millions of advertising dollars on campaigns that talk about why annuities are bad. And I've gone through their documents that they send out. I've put red marks on all of the false information. And one of the biggest things that they say is that there's too many fees and expenses in annuities. And again, there is one annuity that has a bunch of fees, and that's the variable annuity. It has administrative costs, mortality charges, investment management fees, income rider fees, death benefit fees. Like, there's tons of fees that can be in those products. But if you look at the other three types of annuities, there's little to no fees. A MIGA, 0 fee. A SPIA, 0 fee. A fixed indexed annuity can be 0 fees, but if you elect to add an income rider or other type of rider, there can be a fee. And generally on those income riders, the fees are going to range anywhere from, under 1% to 1.3% on average, depending on the specific product that we're looking at. But if fees are important to you, that you want to stay away from them or at least keep them at a minimum, that's what we do. We build the plan and show you the products that meet your needs based on the way you tell us you want us to. If you say that you don't want fees, we're going to find you products that don't have fees. We're not incentivized to offer you products that have fees. We're not paid any more for an annuity that has higher fees. That's hogwash. And anybody telling you that is wrong, and they're not educated on the subject matter. We're paid pretty much the same across the board on each type of annuity. I mean, depending on the type, we're paid in the form of a one-time commission, just to put that out there. But that doesn't incentivize our recommendation whatsoever. We follow the best interest standard, which is a fiduciary responsibility to solely act in the client's best interest. We don't put our interest before yours, and we never will. So we can back that up. We're A+ accredited on the Better Business Bureau. We have dozens and dozens and dozens of positive 5-star reviews of people sharing their experience. And we're proud of that. And we know that our reputation is everything.
I think it also goes to note that the other factor is considering the carrier as well, right? So we're not compensated anything different from one carrier to the other. It's another factor that I want to throw in there because, while different annuity types pay slightly different structure, it's all one-time commission. Other than that, from one carrier to the other, there's no difference in the compensation. So it brings it back to our holistic approach in that we're trying to find the right annuity that fits that client's needs.
Yeah, that's one of the common questions that we get in like first meetings sometimes is they'll say, well, what's the best annuity? We don't know yet. We don't know the answer until we've discovered what's important to you, what matters most. And then we take you through our process that's interactive to rank and sort those annuities top to bottom and based on what you define your goals as. If you're looking at highest lifetime income with a deferral period of 5 years and you're 60 years old or 65 years old, our software, when we plug it in, it's going to rank those products top to bottom chronologically on who's going to pay you the highest, if that's the defined objective. And then we take you through our proprietary process that we call our multi-point inspection or multi-point annuity inspection, where we look at multiple elements and things to consider when evaluating and making an educated decision on which product is right for you. It's not just as simple as who's going to pay you the highest income. You want to take a look at other things based on what you value the most and what's important to you to give you the most peace of mind and comfort now and out into the future. In regards to other downsides and things to consider when buying an annuity, there's one thing that is important, and that is that annuities are considered an illiquid investment. And it's very simple. It doesn't mean that you can't access your money. They consider it an illiquid investment because oftentimes, depending on the annuity type, there's what we call a surrender period, where you're required to keep your money in this contract for a duration of time. And if you were to pull it all out, or what's called surrender, there would be a surrender penalty assessed. But one thing I want to make sure, it's very important that you should never put all of your assets into an annuity. That is not prudent. And quite frankly, if anyone's telling you to do that, they're wrong, and it's against regulation. It's against the law. The rule of thumb, generally, depending on the situation, is at most the amount of assets that you would consider putting into an illiquid investment like an annuity would be up to 70%. And the reason that law or rule of thumb exists is because part of a sound retirement plan is having liquidity and having a plan for contingent events, or what we call unexpected spending shocks. And you need to have a pool of money that's easily accessible to serve that purpose. And when you're going into a plan, that's what it involves, is planning. And you have liquidity as part of the plan. The annuity is to serve as the foundation of income. So think of it like a pyramid. You want to build that first layer or level of blocks of your pyramid with guaranteed sources of income that cover your essential living expenses. Those three sources are going to be things like Social Security, pensions, if you're still blessed to have one, and lifetime income annuities or guaranteed income annuities. But another building block on that is having liquidity, and you should never put all your assets in an illiquid investment. There are free withdrawal provisions inside of these contracts if you do need to access your funds. Most fixed indexed annuities in particular will offer up to 10% of your principal and any interest earned each calendar year. So, if you put 100K in and 1 year you need some extra money, you can pull out 10% or $10,000 in that example, and there's no penalties assessed for accessing those funds.
Yeah. Other than that, if it's structured in a lifetime of income, if you're taking out those funds, then that would influence what that lifetime of income would be, or affect it.
Yeah, it could have some adverse effects there if you have a lifetime income rider and you're taking money out of the account value. Of course, it's going to deduct out of that income benefit value as well.
Right. The next one, I think this carries over a little bit, is the inflationary risk. When we talk about that lifetime of income and how that affects somebody.
Yeah, and that's one of the things that we do get asked from time to time by prospective clients is when we're quoting income annuities, is they'll say, well, does that income increase? Generally, the answer would be no on that, but depending on the annuity, there are ways that income can increase. So let's talk about the single premium immediate annuity or deferred income annuity. Those you can actually build into the contract. They're customizable in this sense, where you can build in what's called a cost of living adjustment, or a COLA. And so how that works is you go in and you in our software, we'll go in and plug in the premium investment amount, your age, when you anticipate turning on the income. And then if we want to build in a COLA to the equation, we can select how much we want that income to increase each year on a guaranteed contractual basis. Generally, the COLA can be adjustable for anywhere from 2 to 5%. Okay, so if you want a 2% increase each year, we can quote that. If you want a 5% increase each year, we can quote that.